The coming week provides perhaps the final flourish within the Q4 earnings season over in the US, with Nvidia heading things up. This is the final Mag 7 name to report within an earnings season that hasn't necessarily been plain sailing for big tech names per se. Alongside that, we have Salesforce, so continuing that AI theme, and home improvement specialist Home Depot as we take a look into the housing market alongside consumer spending habits as we move into 2025. So let's get into it. So here we go. These are the big ticket names reporting over the course of the week. Like I said, Nvidia topping things up, $3.5 trillion market cap. And that has been a hell of a ascent that we've seen over recent years. The company was under 1 trillion not so long ago, and now 3.5. Home Depot second behind that. And then we see CRM or Salesforce, the third in that line. You can see in terms of the dates that we're talking about Wednesday when it comes to Nvidia and Salesforce, then Home Depot on Tuesday. So certainly that AI theme coming into play on Wednesday. So let's start off with Nvidia. Of course, this is going to be the big ticket item for the week when it comes to earnings. And certainly if we're talking about the dramatic ramping up of profitability for this firm, you can see it here. Essentially, you know, if you look back 2015, 2016, we were talking cents. We were talking about 0.03, 0.06, 0.012, you know, growth nonetheless. But coming off the back of a move from 33 cents up to 130 in 2023, this time around, we're expecting 295, then 444, 540, 627. So rapid ascent. But certainly one of the major fears that we have been seeing around this sort of AI move is that we're seeing a lot of companies front loading their spending. That provides the basis for rampant growth rates over a short period of time, but then a normalization. So if you're at a period of time where you're seeing, say, 50%, 70%, 100% growth, and then in a year's time, you're looking at numbers and they're more like 20%, 25%, 30%, then that's the kind of thing that you're looking at, a company that continues to grow, but people are pricing according to future growth as well. So it can impact those expectations for the future as well. But nonetheless, of course, this is one of the biggest growth names in the world, and therefore that rampant ascent expected for earnings per share isn't necessarily unsurprising. The same kind of thing when it comes to revenues, generally outperforming on each occasion. Quarterly, this is sort of where it gets interesting really for Nvidia, because again, we're talking about a company that manages to outperform every single quarter within this view when it comes to revenues, outperformed expectations, and every single quarter bar one when it comes to earnings per share. So generally, we're looking at a company that does beat on both earnings and revenues, and by a significant degree. So this time around, 0.85 expected, up from 0.81. So by and large, you would say, you know, markets have relatively sort of low expectations. So we're laying the ground for significant outperformance. Of course, there has been this huge theme recently about DeepSeek over in China and the necessity to spend ever increasing amounts on these Nvidia chips to be able to get a good end result. Well, DeepSeek supposedly didn't have too many of them, and they got a great result. So does that point towards big tech perhaps so curtailing their spending habits? Perhaps this sees those big tech names moving into a more frugal mode to the detriment of Nvidia. Well, of course, this earnings report should give us a good idea of exactly that. We have the Blackwell chips that are going to be at the forefront of the investors' mindset. Certainly, they've said in the past that they've got huge demand for these chips. So what's their production capacity and numbers looking like? What's the demand picture looking like? What's their outlook and the conversations they're having with their customers? That's going to be arguably as important as the earnings and revenues themselves, because by and large, markets are expecting to see outperformance to an extent, because if you see it every single time, then it doesn't necessarily surprise. But what's interesting for these is looking at how the stock sort of reacts to the outperformance. So this is the weekly time frame, just to show you exactly what we're dealing with over a longer perspective. This is the daily chart that we're seeing here. So That DeepSeek sell-off has provided a recovery that's closed the gap. That could be a warning sign here for this stock, because if you're looking at this recent trend, you're looking at these sort of deep retracements coming into play. There's one, 76.4. The next one that we're in at the moment has moved beyond the 76.4, but we've closed that gap here. The gap low was sort of 142, essentially. So are we now going to fade that once again and sort of continue that sell-off that's happened since the peak that we saw in January, sort of early January? Well, let's look at exactly how things have played out in the past around earnings reports. So here's the report back in November. You can see that we didn't see a huge amount of price action. The initial gains actually faded. We ended up in the red there, and then we sort of trundled lower. So that's not necessarily inspiring. We've got this report here, and we gapped lower and continued to move lower for a week or so, and then ultimately recovered. We've got this move here, so we gapped higher and continued to move higher. We pulled back into a gap higher and then continued to move higher. On this occasion, we didn't see all too much. So I would say there's a bit of inconsistency. Certainly what we're looking at over the more recent times is a bit of weakness about these earnings. So I wouldn't necessarily say that previous experiences highlight that we're definitely going to see a strong reaction towards the upside if we see outperformance in terms of the numbers. A lot of it's going to come around sentiment going forward. Their talk about how their clients are looking, how their clients are approaching things going forward, and spending habits, how much they expect to be producing in terms of the Blackwell chip, how much demand they're getting. Those kind of things are going to be absolutely key. But certainly, given the fact that we've come into this 76.4 fib, there's a possibility that we start to see this sort of rolling over. Are we seeing signs of that? Well, not at the moment. You know, you're sort of seeing something similar to this happening once again. So strong move higher, then almost a retracement. So at the moment, we're not necessarily seeing something that says that we've topped out and we're going to start selling off from here. Of course, earnings have the ability to do that. 129, a key support level that, if broken, would point towards a potential move back down to 113. But as things stand, sort of grinding higher, and we're coming into an earnings report that certainly there have been some question marks around this company, given everything that's happening over in China and the fear that perhaps it's not necessarily a monopoly, a US monopoly when it comes to AI. So this is going to be an absolutely key stock to watch for the week ahead. Next up, let's look at Salesforce. Salesforce is one of those tech stocks that many people don't know what they do. They haven't necessarily seen the most inspiring price action over the years, despite the fact that they're a huge multi-billion-dollar tech company. But it feels like they've gathered a bit of traction over this AI story. And that is mainly around the Agent Force product that they're rolling out. There's this view that in the future, many jobs will essentially be replaced by agents, AI agents, where if it's a sales call that needs to be made, if it's a customer service agent, essentially, that needs to be on the other side of the phone, perhaps AI can do it, and they need to be of a certain standard. But February, this month, sees the release of Agent Force 2.0. So there's going to be a big theme around that. Notably, as is commonly the case with many of these big tech names, we're seeing significant movement in terms of the headcount. They've cut a lot of jobs, but they've also hired, again, in a different area, with significant sales team being built out for Agents Force. So they're certainly gearing themselves towards this AI boom. Here is the outlook in terms of the annuals. So we can see here there's an expectation we go from 822 to sort of 10 to 1121 to 1278 to 1476. Relatively steady growth with regards to earnings per share. Then looking at revenues, you can see here 3480s, 37s, 41s, 45s, 50. So again, growing nicely. Now, bear in mind, they had been coming under a little bit of slack, no pun intended, for, well, it should be flack, but slack, for the fact that in the past they haven't necessarily focused too much in terms of growing their profits, because they've been very keen, and Mark Benioff has been very, very keen to just continue to acquire other companies. And so to grow a bigger and bigger company, rather than just growing the profitability of what they have. So, you know, do we see that ramp up in terms of profitability? Potentially. You know, if you look in the past, it was sort of like 75 cents goes to $1, 135, 275, 299. So it was sort of relatively mundane between that period. And then we've sort of seen a ramping up over the course of 2020 and then sort of a little bit in the years since. But there is a perception that we will see it continue to grow at a decent clip going forward. On the quarterly basis, last time around, we saw it underperform on the EPS number. This time around, we're expecting 261. By and large, they have got a very good track record when it comes to their performance versus market expectations. As you can see here, 1004 expected in terms of the revenues figures this time around. So in terms of the weekly time frame, this is how things look from that perspective. So weekly time frame, long-term uptrend. But like I said, we're looking at a company that gained ground back here, and then we sort of saw a lot of consolidation for a year or so. We boomed, then we bust, then we boom once again, and now we're sort of trying to build on that. We've seen this rally around the whole AI thing, but then now that's starting to falter. You've got the possibility of a sort of double top formation if we see this neckline broken, which would be through your sort of 313s. So that's going to be a key level to be looking out for. But at the moment, we're seeing some of that optimism sort of flagging a little bit. And so if we break through that 313 level, it does point towards a possibility of a significant pullback. It's down to Mark Benioff and Salesforce to really outline the significant financial possibilities of this Agentforce product as we move forward. Of course, I've got a perception that, down the line, there's going to be a huge amount of job losses associated with AI. And whilst they're saying, people are going to live an easier life because they don't have to work as hard and things like that, that's all well and good. But in all likeliness, businesses will just replace them, right? And the businesses will make the money. So, will this be one of the names that is at the forefront of that? And they essentially take advantage of this potential move away from human workers and towards agents and that replace them potentially. But I think once a handful of businesses in a sector do this and do it successfully, if it's good enough, the product, then there's a strong chance that they're going to see many other businesses follow suit when they realize that they can see much higher profitability with lower headcount. And so Salesforce would be one of the beneficiaries alongside the companies that enact that kind of policy as well. But certainly they're at the forefront of one element of AI. And whilst we're faltering at the moment, I think there's a good chance that we do ultimately see this company doing well. You can see here that we've got this sort of uptrend in play. If we do break through that 313 support level and we pull back, then, maybe it's just another one of these, right? A protracted pullback before the bulls come back into play once again. I certainly don't think this stock's, dead in the water, but I do think there's risks below 313. And this earnings report gives them the opportunity to essentially cast aside any fears that people have within the markets. So finally, let's look here at Home Depot, the home improvement, sort of biggest home improvement company in the US. There's significant concerns around spending within this area, mainly because of the elevated interest rates, which mean that people are unlikely to move as frequently. People are unlikely to borrow money as readily. And people might struggle financially because of the costs that they have on perhaps a loan on a car or something like that, right? So you're looking at the possibility that people don't necessarily feel flush with cash right now. And that signals potential weakness for a company like this. The caveat to that is people could say, well, look, the jobs market's doing well. US GDP is doing well. The outlook for the US is good under Donald Trump. And therefore, businesses like this should do well in the years to come, especially when interest rates come down. So there's the sort of outlook and the perception going forward versus the potential here and now. In terms of the EPS, expected for 15.11, exactly the same as last year, so flat on the year. Prior to that, it was 16.69, 15.53. So essentially, they haven't been moving anywhere for years now. And part of that's going to be coming down to inflation. Of course, inflation is a key concern, particularly goods inflation for this company, because they're going to be importing many of the goods that they sell. Revenues 158.81 expected. In terms of the quarterly basis, they have a near perfect track record, essentially a perfect track record for everything that we're seeing here. In terms of the earnings per share side of things, 303 expected for Q4 2024. Q4 2023 was 282. So an increase and heading in the right direction, you would hope. And then we'll go 369, 486, 403 from that. nonetheless, if we're looking at the chart here for Home Depot, it's been pulling back over the recent period. If we just put that on here. So here we go. First and foremost, it's a weekly time frame. So seeing some heavy selling coming into play. Part of that could come around. Let's see exactly when this has happened. Okay, so it's happening earlier in the week. I was going to say we've seen the Philly Fed report coming out with a surge in terms of prices paid. So input costs in the manufacturing sector, which could be a fear for the likes of Home Depot. Higher inflation on that side isn't necessarily great, and there's a degree to which you can pass it on to consumers. But when you've really passed a lot on, I think it becomes increasingly difficult to do so. But certainly many businesses have taken advantage of inflation to be able to up their margins. But I do think that if you keep doing that over a short time frame, people just stop consuming that good. So maybe that's less so for Home Depot. I think people may be a little bit less price sensitive with some of the big ticket items, depending on how much you raise them by. Nonetheless, so we're pulling back at the moment. You could point towards this being a head and shoulders formation, and that would be relevant if we see a breakdown through this neckline support, which is around about 581, 580 kind of area. But certainly in sort of free fall at the moment, we're seeing very sharp declines coming into play at the moment, following a period that had seen sort of deep retracements, right? Each time we're almost breaking through the price swing high or coming into a very deep retracement. Not this time, we're seeing a very sharp pullback. So keep an eye out for this. If we break through the 396 level, it points towards a possibility of a wider retracement coming into play. But at the moment, this stock appears to be sort of at risk of potentially topping out, albeit for the time being at least. And certainly as we move into an earnings report that is going to center upon the health of the consumer, the desire to continue to spend on home improvements, the health of the housing market, which is questionable. There's going to be a really interesting, this will be a really interesting earnings report to be looking out for on Tuesday, I believe it is. So like I said, at the moment, the bears are certainly in charge. We've got the potential for a head and shoulders formation, but the wider context does point towards a possibility that any such pullback, if we do break the neckline, would be looking at a sort of retracement phase, a wider retracement to come into play. You can see this neckline at the moment around the 50% fib level. But ultimately, even if we do see that wider pullback, then that's set within a bullish trend nonetheless. And certainly as we move forward, there is a perception that the Federal Reserve will be cutting rates once again soon enough. That's it for today. I hope that's been useful for you guys. Another busy week ahead in terms of earnings. I'll also provide a video for the economic data that's going to be released with a big focus on inflation. Other than that, my name is Josh Mahony, Chief Market Analyst. Have a great day, have a great weekend, and good luck trading. Thank you.